in the last 1 month. We have with us Azlin Ahmad, the editor of Crude Oil at Argus Media, who joins us on the phone line. Hi, Azlin. Thanks so much for joining in. What's your take? I mean, we've seen a bit of a bounce on crude in the last few days. It's ended at the highest level yesterday, but it's still down close to around 40% in the last 1 year. Do you believe that the uptrend is likely to continue, or do you believe we're going back towards that 40 level out?
I think that we do think that right now the rise is just a very short-term rally. It was driven by the data that came out from the U.S. EIA yesterday about lower U.S. production, but that data is already expected. I mean, the market had already expected that there was going to be a dip in U.S. production because of the lower oil prices this year, and also industry data from the American Petroleum Institute that showed a drop in U.S. weekly inventories, I think gave oil prices an added boost today. But we still have to wait for the U.S. government data that will come out tonight. And I think that if it shows an increase in U.S. crude inventories, we will probably see prices dip again tomorrow or tonight.
Okay. So this data about the U.S. crude production falling by 120,000 barrels per day from August to September would not give you the suggestion that the global supply glut perhaps is easing. That's not your thinking.
No. It's already been expected that the U.S. crude production would show a dip by the third quarter, the fourth quarter. I mean, that was already the expectations of most analysts and even our expectations. But globally, the market remains well supplied. We still see OPEC production at high levels. No indications that any of the OPEC producers will cut output anytime soon. And overall, demand against supply, we still see a very well-supplied market, and that will continue probably throughout this year and probably into next year. So the drop in the U.S. production will be more than offset by ample supplies and ample production the rest of the world.
All right, Azlin. So let's get in then a worst-case scenario and the best-case scenario. Give us a couple of levels. On Brent crude, do you see us going towards 30? And in a best-case scenario, can we go towards 65, 70? Give us some numbers.
I think that our expectations, looking at the scenario right now, we do still see that ICE Brent will probably remain in the high 40s level the rest of this year and going to first quarter of next year. If there is any decision by OPEC or any move by OPEC producers to actually reduce production, that could push oil prices back up to about $60, $70 next year. But that scenario looks quite unlikely. But looking at the market right now, prices may not fall drastically. The only thing is that the market is a little bit concerned about demand growth, looking at China. So I think that's the uncertainty in the market, which could push prices lower if demand from China turns out to be a lot weaker than expectations.
Any levels that you can leave us with on Brent, say for this quarter as well as the next 6 months?
I think we do still see that ICE Brent should be about the $48, $49, quite stable in a very tight range for the fourth quarter this year and for the first quarter of 2016.
Okay, Azlin, we'll leave it at that. Thanks so much for joining in. So the crude market will continue to remain oversupplied, and there is also an added concern about slower demand from China, which could put pressure on crude prices. So according to them, they see Brent trading around $48 to $49 per barrel for the next 1 or 2 quarters.